Options trading offers a variety of strategies for investors of all levels. One such strategy, the bull-put spread, stands out for its income-generating potential. This strategy allows traders to profit from a neutral to bullish market outlook while mitigating risk. In essence, a bull-put spread involves selling a put option and simultaneously buying another put option at a lower strike price. Both options have the same expiration date. This creates a spread, or a range, within which the trader anticipates the underlying stock price to remain. The beauty of the bull-put spread lies in its defined risk and profit potential. By selling the higher strike put option, the trader receives a premium, which represents their maximum potential profit. Conversely, the maximum loss is limited to the difference between the strike prices minus the premium received. As with any options strategy, understanding the mechanics of the bull-put spread is crucial. In the following sections, we will delve into the specifics of this strategy, exploring its nuances and providing a practical example. The bull-put spread is an income-generating strategy. This means that the trader aims to profit primarily from the premiums received when selling the put options. These premiums represent the price that option buyers are willing to pay for the right to sell the underlying stock at a predetermined price. When you initiate a bull-put spread, you receive a net premium, because the premium received from selling the higher strike put option is greater than the premium paid for buying the lower strike put option. This net premium is your maximum potential profit. Think of it as renting out a piece of property. You receive rental income or premium up front, and as long as the tenant doesn't exercise their right to buy the property or put option exercise, you keep the entire income. The goal of the bull-put spread is to have both options expire worthless. This happens when the price of the underlying stock remains above the strike price of the short put option. If this occurs, you get to keep the entire premium you received at the outset. The bull-put spread is best suited for a market outlook that is either bullish or sideways. This is because the strategy profits when the underlying stock price either rises or remains stable above the strike price of the short put option. In a bullish market, the underlying stock price is expected to rise. This works in favor of the bull-put spread because the higher the stock price climbs, the less likely the put options are to be exercised. As a result, the options will likely expire worthless, allowing the trader to keep the entire premium. Similarly, in a sideways market where the underlying stock price fluctuates within a narrow range, the bull-put spread can still be profitable. As long as the stock price remains above the strike price of the short put, the trader can benefit from time decay, which we will discuss in a later section. However, it is important to note that the bull-put spread is not suitable for a bearish market. If the underlying stock price falls significantly below the strike price of the short put option, the trader could incur a loss. Let's illustrate the bull-put spread with an example using Kimberly-Clark, a company known for its consumer products. Assume that Kimberly-Clark is currently trading at $150 per share. You believe that Kimberly-Clark's stock price will either rise or remain stable in the near future. Therefore, you decide to implement a bull-put spread by selling one Kimberly-Clark March 145 put option for $3 and buying one Kimberly-Clark March 140 put option for $1. By selling the March 145 put option, you receive a premium of $3 per share, or $300 in total, since one option contract represents 100 shares. Simultaneously, by buying the March 140 put option, you pay a premium of $1 per share, or $100 in total. Your net premium received is $2 per share, or $200 in total, which represents your maximum potential profit for the trade. Your maximum potential loss is calculated as the difference between the strike prices, which is $5, minus the net premium received, which is $2. Therefore, your maximum potential loss is $3 per share, or $300 in total. Setting up your bull-put spread. To set up a bull-put spread, you would follow these simple steps. First, choose an underlying asset. Select a stock or other asset that you believe will either rise in price or remain stable. Research the asset's historical price movements and consider any upcoming news or events that could impact its price. Next, select strike prices. Choose 2 strike prices. Sell the put option with the higher strike price and buy the put option with the lower strike price. The difference between the 2 strike prices will determine your maximum risk and potential reward. Then choose an expiration date. Choose an expiration date that aligns with your market outlook. If you expect the underlying asset price to remain stable or rise in the short term, choose an expiration date a few weeks out. If you have a longer-term outlook, you could choose an expiration date several months out. Finally, place your trade. Once you have chosen your underlying asset, strike prices and expiration date, you can place your trade through your brokerage account. Ensure that you have sufficient funds in your account to cover the potential loss of the trade. Managing your bull-put spread. Once you have established your bull-put spread, you will need to manage the trade according to your market outlook and risk tolerance. Here are a few key things to consider. 1. Monitor the underlying asset price. Keep a close eye on the price of the underlying asset. If the price moves significantly against your position, you may need to adjust your trade or exit the position entirely to minimize your losses. 2. Adjust your position. If the underlying asset price moves in your favor, you may want to consider adjusting your position to lock in some profits or reduce your risk. For example, you could roll your put options up to a higher strike price for a net credit. 3. Exit your position. If you are satisfied with your profits or if the trade is no longer aligning with your market outlook, you can exit your position by buying back the short put option and selling the long put option. You can also choose to hold the position until expiration. Time decay, your silent partner. Time decay, also known as theta, is a crucial concept in options trading, and it plays a significant role in the bull-put spread strategy. It refers to the rate at which an option's value erodes over time. As an option approaches its expiration date, its value decreases. This is because there is less time for the underlying asset's price to move in a favorable direction for the option holder. Time decay works in favor of the bull-put spread seller because they are essentially short on time. The closer the options get to their expiration date, the faster the time decay occurs. This means that if the underlying asset's price remains stable or moves in your favor, the value of your put options will decrease and you will be able to buy them back at a lower price than you sold them for, thereby realizing a profit. The advantages and disadvantages of bull-put spreads. Like any investment strategy, the bull-put spread has its own set of advantages and disadvantages. Understanding these is crucial for determining if this strategy aligns with your risk tolerance and investment goals. Advantages. Defined risk. Your maximum loss is limited to the difference between the strike prices minus the premium received. Income potential. You receive a net premium up front, which represents your maximum potential profit. Time decay. As time passes, the value of your options erodes, working in your favor. Disadvantages. Limited profit potential. Your maximum profit is capped at the net premium received. Potential for loss. If the underlying asset's price falls significantly, you could lose money. Requires monitoring. You need to monitor the underlying asset's price and adjust your position as needed. Conclusion: bull-put spreads in your options toolkit. The bull-put spread is a versatile options strategy that can enhance your trading arsenal. By understanding its mechanics, you can leverage this strategy to generate income and potentially profit in a flat or moderately bullish market. However, it is crucial to remember that no investment strategy is without risk. Before employing the bull-put spread, carefully assess your risk tolerance, conduct thorough research, and consider seeking advice from a qualified financial advisor. By approaching options trading with knowledge and prudence, you can navigate the complexities of the market and strive to achieve your financial goals. Good luck with your trading, and do not forget to like and subscribe.